Hey, thank you so much, Ethan. And of course, thank you all of you for tuning in today on a Saturday morning for some, Saturday afternoon for some. So really thank you for, taking the time off your weekend to tune in to really, find out more about our views. So my views today will be all revolving around the Asia Pacific, the region. As Ethan has mentioned, I'll be touching on some of the markets such as, Japan, of course, China, Hong Kong, and also last but not least, Singapore, because I'm from the Singapore office here at IG. So without further ado, I'll just jump straight into the content. So just like a disclaimer, usual protocol, this presentation is for educational and informational purposes only. Of course, it does not in any way constitute any investment advice. So please do your own due diligence when trading or investing. Okay, so this is me. I shall not dive deeper. I mean, Ethan has provided quite a good introduction about where I come from, who I am. But just two things that you may be interested. One will be the Twitter account. So for those who have Twitter, I actually have this Twitter account at @Yeap_IG, where occasionally I will be posting some trading ideas or a news update that you may be interested. But the second one I think could be more important, which is that we have this Telegram group, which is called IG Asia. So every day, almost every morning, there will be updates on key asset classes, some of the trading instruments that you can look at, and it's actually a collation of various content from analysts, from IG analysts across the world. So you'll get content from a currency, FX, commodities, indices. So I mean, if you have a Telegram and you are interested in receiving some of the updates on a more frequent basis, do feel free to join this group called IG Asia. Okay, so looking at Asian indices year-to-date performance, of course, they are just some of the selected ones. We have seen that the Straits Times Index, the Singapore Index, has been quite resilient. Year-to-date, it is still at a positive return. Okay, we are seeing some volatility, but year-to-date, they are still able to sort of eke out somewhat of a slight positive return. Faring next, not too bad. I think Nikkei and also the ASX, they has also been quite strong year-to-date. So just barely, slightly below the negative territory. And last but not least, of course, we have the China indices, the CSI 300 and the Hang Seng Index. And we know that they have been, hit quite hard, from all of these regulatory reforms, this zero COVID policy. But recently, we are starting to see some of a shift, and there was quite a strong rebound in October. So moving on later, I'll talk a little bit more. I'll elaborate more about these China indices. But for now, it seems that the Straits Times Index has been somewhat quite resilient. And if you really delve deeper into why this is so, largely because Straits Times Index, the greater composition is around the financial sector. So in a way, if we are talking about a higher interest rate upcycle environment, there are somewhat of a cushion for this banking sector itself. And of course, when we are talking about financial sector, other than the interest rate environment, the other part that we have to take notice will be the economic conditions environment. Because it doesn't mean that when interest rate is high, yes, they are able to sort of charge higher for their loans. But if the economic environment is down, loan demand could fall. So there could somewhat be some a netting form of an effect here. But for now, if we look at the recent result from the banks, we have been receiving a positive guidance in that they are not expecting much of a downturn. So in short, the statement seems to point towards some form of a resilience, at least in the Singapore's economy itself. So with that, we are seeing quite a strong recovery. We are seeing quite a strong recovery for the Straits Times Index. And the next one will be the ASX and also Nikkei. So somewhat we can see that Asian indices have been quite resilient year to date as compared to the Western counterparts such as in the US. And one of the reasons is because the COVID-19 recovery has not been as robust for the Asian Pacific Index as compared to the S&P 500. And largely because if you were to ask me the reason, personally, my own opinion is that the S&P 500 composes of a greater tech composition, and that tech the tech sector has been benefiting from this tailwind from COVID-19. When there's previously there was this work from home, there was this switch towards a digital transformation, remote networking, those kind of things that really boosted the valuation for the tech sector. So I think that kind of lifted the US indices in a way, because much of their not much, but they have a significant percentage of their companies that are sort of exposed to all of these tech tailwind. But moving into this year, we are also seeing a greater sell-off in the S&P 500 as compared to Asian indices. So part of the reason we know is that monetary tightening is kicking in. So many of these tech companies are really trying to justify the lofty valuation that markets have given them during the COVID-19 boom. So now our growth has slowed. Okay, we are almost back to economic normalization. The COVID-19 seems to be more of a past, sort of taking a back seat. So many of these valuation has been revisited, and with this monetary tightening, that really warrants more of a re-rating among these tech companies, and that kind of bring that S&P 500 down to a larger extent. So Asian indices is dragged down as well, but generally year to date wise, the performance still somewhat resilient, and Asian indices kind of drag because when we're talking about monetary tightening globally, there's really the demand outlook is really put in question. How much economic conditions will moderate. So that kind of weigh on the Asia Pacific. But looking at this, the Asia Pacific Index previously has reached not almost near, but I would say it's sort of near this COVID-19 bottom back in February 2020. Still a distance, but it's getting close. So I would say that just based on this performance divergence, whereby we can expect more re-rating from the S&P 500 in terms of valuation compared to the Asian Pacific. I would say that there could be sort of a lesser extent of a downside in the Asian region as compared to the US counterpart, just based on this valuation point of view. And Asia Pacific Index tends to trade more on a value basis. So there was this, these two categories of value companies and also growth companies. So we're talking about higher interest rate environment. Generally, people tends to lean towards value companies, considering that they have a more stable cash flow. And of course, they have a greater better balance sheet as compared to many of these growth sectors. And of course, in terms of valuation, once more, value tends to draw a relatively lower valuation as compared to growth, because growth, a lot of this valuation is priced towards their future potential, whereas value-wise, a lot of the valuation is priced into their current potential. So with that, moving forward, I think if the interest rate continue to push towards a restrictive territory, the value and growth kind of a narrative could continue to play out. I mean, we could see further many of these growth companies may start to give in more that warrant or more sort of a re-rating of their lofty prices. And value could see somewhat of a cushioning. I mean, people could start to lean more towards value companies, and I think Asia Pacific is somewhat well positioned to benefit from this proposition. Okay, so this is just the another chart to show the sort of the divergence in performance between Asia Pacific and S&P 500. So generally, since 10 years back, this is the 10-year chart. The S&P 500 has been sort of pulling ahead of the Asia Pacific Index. You can see that it has somewhat been on an upward trend in terms of the valuation difference. So generally, I believe that part of this is once again due to the tech composition. So over the years, there has been somewhat of a lean towards the tech companies. But recently, with this narrative change in terms of the interest rate environment, things are really starting to sort of reverse. So we are revisiting these tech companies more, and that cause, I believe that should drive somewhat of a re-rating in terms of bringing down this divergence between the US counterpart and also the Asia Pacific region itself. Okay, so looking across the whole Asia landscape, whether we will get a recession or not. I mean, of course, the definition, textbook definition is, 2 quarters of contraction in the economy. So looking at the growth forecast from the IMF, next year we are looking at around 4.3% for the Asia region in terms of the total GDP growth. I mean, that is clearly well below the average. The average is around 5.5% over the last 2 decades. So there are clearly some moderation being priced into next year. I mean, that's sort of a given, considering that a lot of these growth forecasts are being brought down. But for the Asia region itself, the positive sign, the room for optimism is that the growth has started off from a higher base. So 5.5% average over the last 2 decades. So if we were to see further moderation, 4.3%. Compared to historical is bad, but if we compare across the regional, across developed market, 4.3% seems to be sort of a more resilient figure. So global growth forecast is at 2.7% next year, whereas the US growth forecast is just at 1% in 2023. So I would think that if we are trying to answer this recession question, US seems to be more in a more precarious position. Considering that their growth has already sort of started out on not as high as a base as compared to the Asia region. So looking across the various different countries, I have this chart here that shows the extent of inflation versus their the central bank's target rate. So we have Philippines sort of still trying to really have a lot of room to bring down inflation. New Zealand as well, Singapore for sure, Australia, Thailand also. So many of these many of these countries, I would say that they will have to continue sticking to their tight monetary policy moving forward. But the good thing is that the divergence away from the gap away from their target rate is getting closer. Okay, of course, bearing Singapore, I think Singapore, due to its export-oriented economy, it seems to be getting more imported inflation from the Western counterpart. So that really brings its inflation picture into question. But looking across the other countries, I would say that there has been progress. There has been progress in inflation coming down towards their central bank's target rate. So moving into next year, yes, we may be talking about a slowdown. We have already seen that in many of the central banks in the region, such as the Australia. The RBA has been one of the central banks that kick off the slowing down of a rate hike process. They are one of the central banks, and recently I would say that it has been showing somewhat of a positive result. I mean, they have to some degree proved that they are right in terms of slowing down the rate hike process. But the process will continue in next year, and moving into that, we will be looking towards when we can see a pause. But overall, I believe that much of the front loading of these rate hikes could have already been done this year. So moving next year, the markets will really have their focus towards the growth prospect. I think the question will not be whether inflation has peaked, because for now, if you ask on the streets, probably 95 to 90% will tell you that sort of inflation has peaked. We have seen it peak in headline. Core maybe not so much, but headline, yes, we have seen a peak in inflation. But the next narrative that we have to struggle with will be, rates will stay at that level for long. So how will economic conditions hold up? So that will be the key narrative that I believe markets will shift towards pricing into for the whole of next year, whether we will have a recession or not. So Asia-wise, somewhat holding up. I would say it's down, but not out, as you can see in bold there. I think that moderation across the whole global landscape is definitely warranted. But it just, from that high base itself, it helps to sort of cushion the Asia region into falling into a contractionary growth. Okay, another relationship that I think we can definitely keep a lookout for in terms of the Asia Pacific region will be the US dollar. So if you were to plot the 20-year or 20-year chart, or even extend it out to a longer time frame, generally you can see that there is an inverse relation between the US dollar and also the Asia Pacific Index. So this red line here that you see is the US dollar index, on the inverse scale, whereas for the blue line will be the MSCI Asia Pacific Index. So generally you can see it's somewhat of an inverse relationship. Some of the reasons is that, many of these emerging Asia economies are exposed to US dollar debt. So with US dollar moving higher, these debt cost burden on these economies are greater. So that could account, one of the reason why there is this inverse relationship. Another is because of input costs. Many of the input costs are dominated in US dollar. So when US dollar increase, there are also a greater cost pressure on many of these firms. Such as, if you're talking about Japan, they are energy importing economies. So recently, previously they have been sort of weighed by the strong US dollar, but recently the pressure seems to have eased a little bit. So we cannot really, pull away, don't look at the US dollar if you are talking about Asia index, in my opinion, and as you can see from this inverse relationship itself. So moving forward, yes, if you look at the US dollar, I think it has really come out. It's a peak in October. There has really been some unwinding of this bullish build-up that we have seen across the past 1 year. And recently there has really been some unwinding. If you look at the COT position, it also shows that some of the money managers are also sort of paring down on their US dollar exposure. And just by looking at the chart itself, I would say that recently we have been seeing this lower high and lower low. So personally, I'm looking at the trend. So it just suggests that, near term, the trend is still to the downside. Just based on this low series of a lower price high and lower price high, and lower price low that is being formed. And I will look towards the 105 level. Generally because I think there was sort of a Fibonacci level there. You can see from the dotted line. It has previously proved to be a support. We can see some deep buying. There was a bullish hammer being formed just in mid-November. That failed to hold. Upside has been short-lived. That level was broken. Previously, there was a retest, and but that did not really, overcome it. So I think there is this ongoing battle, key battle between the bulls and the bears at the 105 level. So we really have to see, whether the US dollar bulls can actually overcome this 105 level, considering that we have seen that strong PPI just yesterday. We are looking towards the US CPI next Tuesday, and last but not least, the FOMC meeting, which there have been chatters that there will probably be a more hawkish message being laid out. So I think the 105 level will be key, but generally for now, it does seem that it is still on a near-term downward bias, in my opinion. Okay, when we talk about Asian, I think a lot of the performance is also tapping on our US counterpart. US accounts for the bulk of a lot of the global economic growth, so we cannot really pull away that relationship there. Just looking at the US side of things, I think if you look at the VIX, it has really been trying to defend its 20 level. So why is this 20 level very significant, in my opinion? Is that this 20 level is sort of the longer term 20-year kind of a median reading. And a lot of these low volatility funds, they are also looking at the VIX, and when volatility is low, that could prompt some of them to take on a greater exposure. So I think this 20 mark is really sort of the divide. It's looked upon as this divide between a more risk-on environment and also a risk-off environment. So that is the kind of a line of a divide there. So previously, we have seen the VIX trying to, push below the 20 mark, back in August, back in April, and it did not really play out as well. And recently, we are back to this level again. So recently, it retested the 20, and then there was somewhat of a surge. So near-term wise, I would say probably there is still headwinds, there are still a lot of uncertainty, a lot of a wait and see, and especially heading into CPI. That is the key inflation reading, and also the US Fed meeting. I think last week we have seen, just this week we have seen a lot of de-risking. Many people are start to reducing their risk exposure ahead of all of these key risk events. So near-term wise, it will still be volatile. if the US are not able to sort of, revert to the upside, that could create pressure for the Asian indices as well. And looking at this VIX index, I think the cautious environment still seems to be playing out, looking at this recent defending of this 20 level. Another thing that I'm looking at is other than the VIX, which will be the sort of the VVIX, that is the volatility of VIX. So recently, if you look at this VVIX chart, it has also been trending near its support. So there has been a very key line of support here around the 75 level. So there has been various bottoms across the year. There is being marked, by this 75 line. So recently, it's back to retest this line again, trying to hold up somewhat of a consolidation at the near term. As we have this quiet economic calendar, this Fed blackout period, so that kind of remove comments from Fed members for the past week. So there has been some struggle to sort of determine what kind of expectations to have moving into many of the key risk events next week. So there has been some a push and pull, but for now it's still holding above the 75 level. But the key risk that I think is this: if we were to see a surge in VIX volatility, generally when we talk about volatility, that sudden jerk in the volatility, of course you can say that it's to the upside, but most of the time it tends to be to the downside. Okay, so if we were to see this huge surge in this VVIX, I think it sort of provides a greater validation that there could be sort of a risk-off kind of environment moving forward. We could see VIX defending that 20 level, and that could create downside risk for US equities. That could have a knock-on impact on Asian equities as well. So the near term, definitely a more cautious environment that we are looking out for, and do expect it to the key CPI next week and also FOMC meeting will be key in really driving the trend over the next few weeks or towards the end of the year. So for now, if you look at seasonality, if you look at December, generally the first 2 weeks of December tends to be shakier. And we are talking about the festive rally and also the Santa Claus rally. Things starts to pick up towards the year end, but that is purely based on seasonality. I personally may not read too much into it. Economic conditions do change, and we are talking about a higher frequency, a higher occurrence of a bull market across the years as compared to bear market. Of course, we will be getting somewhat of a positive when we look towards the month of December. But this year is actually, we know that it's a bear market year, right? So whether this seasonality effect will really start to play out, generally I will not, sort of read too much into it. I believe that a lot is still dependent on, the fundamentals and also the catalysts that are present in December. And that will, of course, be the FOMC meeting that is coming up. Okay, so some of the downside risks, even though I believe that Asia can be sort of a better cushion as compared to the US, but some of the downside risks globally that can be highlighted will be, this sharp deceleration in global growth, this stronger than expected monetary policy tightening, in that, terminal rate has to go above what is expected currently, escalation of the Russian invasion, more spillover on the global commodity markets. Of course, the China, we are seeing somewhat of a reopening plans, but if the pace is slow, if you are talking about intermittent virus surge, that could still keep some consumers away from the street in terms of spending. If you are talking about rising virus cases, that could still hamper some of the manufacturing factories. The labor force, if they will have sort of a virus spread, much of the labor force could be out. So that could hamper the manufacturing activities, at least in the near term. So that could also pose somewhat of a downside risk if things do not go as well. And of course, the emerging of a new COVID-19 variant, probably more of a backseat, but still nevertheless one to look upon. Okay, so now I'll dive into the various individual markets. So Japan, I think Japan, across all of the Asian indices, Japan has been tracking the S&P 500 the most closely. largely because their composition is somewhat similar. I mean, they have a very significant tech composition similar to the S&P 500. So I would say that generally, make them more sensitive towards the S&P 500 movement. Okay, so we will have to look towards the S&P 500 if we want to gauge the movement of the Nikkei. So for now, things are still, I would say, mixed. Of course, near term, we have this ascending channel pattern that is sort of lifting the S&P 500. But longer term, we really have to see that downward trend line being overcome. So for now, the answer to whether, where things will go is really kind of a mixed picture here, largely because there wasn't much of a clue. So with these conflicting near-term upside bias, along with a longer-term downward bias. So we'll have to see how it goes, but generally my opinion is that we could move below to retest the 3,800 level. That is where we are seeing this confluence of support, based on the Fibonacci and also the lower trend line of the ascending channel. And when we talk about Japan, Japan is a net, energy importing countries. They are very dependent on, energy exports for their economy. So definitely, when we look towards oil prices, that will really play a part. So previously, oil prices is high. We can see that, that has created a lot of pressure on their firms itself in terms of, this margin compression. But moving ahead, we are seeing oil prices coming down. That could provide some of a tailwind for these, for these Japanese firms that can, enjoy sort of a slight recovery in margins moving forward. And if you were to ask me about the outlook for oil prices, generally I'm looking at this CFTC net long positioning among money managers. So these are released every Friday, but it's somewhat of a backward-looking positioning for Tuesday. So there's somewhat of a few days of a delay, but nevertheless, it does help to sort of provide a good picture of where the trend or where the positioning among money managers are at. So we are seeing previously there was a sharp build up in 2020, another sharp build up in 2022. But moving into recent months, there has actually been a pairing of a net long positioning. So what this means is that many of the money managers are sort of reducing their net long exposure to Brent crude oil. And we talk about that, the key factor is, of course, the uncertainty around the global economic picture. I think it's really hard for a lot of these firms to pinpoint when we can really see the bottom in terms of economic conditions. So that really prompt many of them to, with all this uncertainty, that kind of prompt many of them to reduce their net long exposure. So if you were to ask me, I believe Brent crude prices could feel more to be towards the downside, considering that many of these money managers are not, exposing themselves as much as compared to previous years. So we probably have to see a return in terms of these money managers' positioning to dictate greater confidence in oil. But for now, it does seem that the risk is to the downside. So we will have the next OPEC Plus only in February. So whether they will have more production cuts, that will definitely be the top of the town. But we have seen that in October. The OPEC Plus has cut production in October. That provided a near-term, just a knee-jerk upward reaction. And after that, the trend remains down. So, it really begs the question of how much more, the OPEC Plus has to cut in order to convince the markets that, they are really trying to provide a floor for oil prices. But for now, it does seem that the risk seems to lean towards the downside. And for Japan's Nikkei, I think if you talk about growth projection, slightly weaker, 1.7%. 1.6% next year. This year is 1.7%, slightly weaker. Of course, the weak external demand. But if you are talking about, just a 0.1% moderation, I think it is still somewhat of a pockets of a promising sign. And largely because Japan is also having this delayed reopening from COVID-19. So just a few months back, they just started to open up their travel borders. So, this tourism influx could potentially aid to cushion, some of their retail spending right there. And Japan accommodative policy are set to remain, and recently not as much upside pressure in terms of energy prices. I think that allows them some room to really keep their policies intact for now. And if you are talking about the US Treasury yields, one of the factors I'm looking at this is because of its tech composition. So the previous narrative is that when US Treasury yields are up, the growth sensitive tech composition will be down based on this higher cost pressure, higher valuation kind of argument. But moving into next year, I think I'm still looking for the turning point. The turning point is that when equities fall and US Treasury yields fall as well. So why this can be so is because if you look at previous economic downturn, that has been that relationship playing out. So for now, the narrative is still around monetary policies. So with US Treasury yields up in terms of a tighter, a more hawkish outlook in Fed policy, that weigh on equity. So that is the current argument. So I'm looking for the really turning point where both US Treasury yields and equities could fall together. So that is where I think could be the sign that markets are shifting their pricing towards recession, towards an economic downturn. So that can definitely be one to watch. But for now, based on that, Japan, I think we have some of the catalysts that are providing some of a cushion in terms of the downside impact as compared to the US counterpart. So for technical wise, Japan Nikkei has been trending across this I would say this largely in consolidation. Previously there was this rising wedge sort of broken down, but the longer term is really still in this consolidation mode. I would say we will really have to see a break above the 28,400. That the index has previously failed to broken above this level on many key occasions. Recently it's at support, but we really have to see a break above this 28,400 to really move towards retesting its September last year's high. Okay, next will be the Singapore's outlook. Hopefully I still have some time. Yes, I do. Okay, so for Straits Times Index, I think one of the key things that I always monitor is this fund flow index. So it's actually published on the SGX website every Monday. So it actually tells you the past weeks, how are the fund flows moving around. And one of the key things is, of course, the institutional fund flow that we are looking at, considering that they are the better informed investors, they are the one with the deeper pockets. So generally, I'm looking at this institutional fund flow data. And looking across the whole year, generally, when we talk about upside in the index, it tends to sort of be more aligned in terms of huge net inflow from these institutional investors. So recent weeks, somewhat of a muted picture, largely because economic calendar was quiet. There wasn't much of a Fed speakers just over the past week due to the blackout period. So I would say many of these institutional funds are on this wait and see. As we can see that they are not really, there wasn't really much change in terms of their net inflows or even net outflows into the STI itself. So somewhat of a wait and see, but before that wait and see period, we are actually seeing some build up. So you look towards the early November period, there has actually been some net inflows among these institutional investors. So there was some return of confidence. So if we are able to sort of see more inflows, and of course technical wise, if we are talking about a break above the 3,300 level, I think that could suggest a better, more sustaining reversal to the upside, in my opinion. But for now, past few weeks things are relatively muted, but we can definitely keep a lookout, and I think it does provide a very good picture for where are these funds going. So it published on the is published on the SGX website every Monday. So I mean, if you are interested, do feel free to really keep a lookout on where the institutions are sort of placing their position. Cumulative wise, I would say just throughout this year, you can see a divergence. Institutional investors are sort of de-risking, they are reducing their exposure, but retail investors are the one that has been picking up all of these equities. And looking at the performance wise, the weak macro environment, it does seem that institutional investors have their reasons to be cautious. So a turning point will be what I'm looking at. For now, it does seem that across the August period, we are seeing some improved fund flows from these Singapore institutional investors. So whether this can continue, I think it will be one that will be interesting to watch. Okay, in terms of sector breakdown, many of these institutional funds are heading into the financial. So the STI largely composite of these three major banks, DBS, OCBC, UOB. So if you just look at where are these funds going, they are heading into financials. We are seeing sort of a recovery since the May period in terms of net inflows. Where are they shunning? I think the institutions are shunning the REIT sectors. So REITs has been on a very strong outflow, since May 2020, and largely because if you are talking about a higher interest rate environment, generally REITs are more dependent on debt to finance their growth. So that could really account for that loss of attraction in terms of the REIT sector until we are able to sort of find a bottom in terms of rates. And if the Fed funds risk sort of the look upon a risk-free rate is heading towards a 5.25 to 5.5%, many of these REITs are dividend-paying companies. So that is their selling point. So if you buy REITs, most likely you are going in for their dividends, for their stable dividends. And if you are talking about a risk-free rate, moving to the 5% range, the REITs dividend yield really has to deliver somewhat of a risk premium, a comfortable risk premium for investors to really take on the risk that they are exposing themselves to in terms of economic conditions. So generally, I would say REITs, why maybe a 7 to 8% form of a dividend yield is attractive. But for now, we really have to see somewhat of an indication of a peak that interest rate that terminal interest rate, the market price will not really need a hawkish calibration. And until we see that, I think the traction towards REITs, at least among the institutional investors, could still remain low. So their preference for the Singapore market will still be towards the financial sector. If we look towards the growth projection, Singapore's growth projection is at 2.3% next year, down from 3% this year. Not too bad. I think there is a chance, of course, looking at this, there's a chance that we may avoid a recession, 2.3% throughout next year. Still somewhat positive growth, even though some moderation in the global demand, providing this a headwind for its exports oriented economy. But 2.3%, I think that could still be kind of a resilient picture that we are looking at. Okay, so for STI, near-term wise, really some trading within this range, this ranging pattern, and that provides some of a clue, right? I mean, if you want to trade within this rectangle pattern, definitely one is to take up short when it hit the upper rectangle resistance, or you pick up a long when it hits the lower range, or the other strategy that you can look out for will be in terms of breakout. Whether it really break above that upper range and then you take up a long, or whether it break below the lower range and then you take up a short. So generally there could be a different bearing of a trading strategy that you can implement just based on here. Okay, last but not least will be the China's outlook. So we know that previously, just based on some of the economic data, China's economic picture has not been pretty. They are really coming off a lot in terms of their retail sales, fixed asset investment, industrial production. So it kind of a lot of confluence of headwinds hitting them at once. We have that regulatory risk. The good thing is that if you look towards the tone, it has not been as strong as compared to the start of the year. So that really kept some expectations that the worst could be over in terms of regulatory risk. And generally, if you look across history, there has been various stages of regulatory reforms playing out across the different sectors. It's just that this year it is the tech sector that is being put into the crosshair. But if you look towards various the past performance, generally markets tends to get over it after a longer term period kind of a thing. So I believe that we will also get through it in terms of regulatory risks and having this sort of quieter tone from authorities recently. I think that really provides somewhat that the upside could be more promising than the downside. And I think they wouldn't want, the economic growth is their priority now. So recently we have seen a sort of a shift in the focus in terms of the tone. So previously they are focused on preventing this COVID-19 spread. They are willing to forgo economic growth to really sort of save prevent deaths. But recently there has been a shift in tone, brought on by this protest. There has been a greater focus towards prioritizing economic growth moving forward. So that accounts for many of these easing measures that they kick in very quickly over the past 1 month. Moving ahead, I think more measures will follow, but my timeline will be towards the March-April period next year. Largely because January we are looking at the Lunar New Year, which is a very big festive event in China. And I think there could be a possibility where we could see some renewed restriction kicking in just to really tackle many of the spread that could be brought on by this Chinese New Year. Chinese New Year, people travel, people visit their relatives. That is where, when you loosen, things really, the cases really surge. So I think more of this significant reopening could come around March, April. I think that provided sort of a good timeline potentially for the China authorities to look at. For now, things are still muted. Economic data showing very, very weak growth. Even the consumer price index, inflation is not much of a problem in China. It is still far below their PBOC's target of 3%. So it does provide room for easy policies. But recently, I think we have heard that they are trying to depend less on these easy policies, but are really trying to go into more reopening measures. Because over the past 1 year, we have seen a lot of easy policies, various cuts to the RRR, that really did not really pay out well. Because these COVID-19 restrictions are still the hampering block that are, offsetting a lot of these easy policy conditions. So with that, the reopening is still the key, and I think they realize that, and they could be the focus heading into next year. Okay, some thoughts on this China's reopening story. I think we may expect intermittent wave of a virus surge ahead. That is always the case when we talk about loosening of restrictions. Or we may be experiencing, China may be experiencing more cases of death. Probably more stories of hospitals not able to catering to this surge in the severe COVID-19 cases. So that could be what we are looking at into next year. That could prompt some of the sell-off. But personally, I believe that the worst is over. We have seen many of these instances in many countries where with reopening, things are always shaky at the start. The road to achieving a full reopening is always bumpy. It is not a smooth kind of a process, because we will have to deal with this intermittent wave of virus, especially for a very dense populated places like China, huge population. We could be expecting cases similar to that of India. So previously, India has seen this huge record number of deaths from this COVID-19. That could also play out. That could create some form of uncertainty, instability in the markets. But generally, I believe that the worst is over. Once we get through it, the economic growth conditions could recover. But it will take time. But nevertheless, it does suggest that the trend is still, the overall trend could still lean toward the upside for now. And of course, I think preparation will take time. I think lead up to Chinese New Year may draw some restrictions. I think that is a very good narrative to really force some of the weaker hands. I mean, when all of these news headline of economic reopening came out, I think many of the investors, traders have jumped on board. So you know, for this upside to really sustain, I think there has to be an intermittent retracement to really sort of force many of these weaker hands out. I think the renewal restriction into Chinese New Year could be one. You know, some headlines, more negative headlines towards, you know, death, rising number of deaths, you know, manufacturing activities getting disrupted due to, you know, labor force getting having this virus spread. I think those could be catalysts that can draw some jitters into Chinese equities. But generally, that is, you know, that are steps towards a full reopening. And generally, the higher low will be what I'm looking out for in terms of in terms of China indices. So in terms of valuation, the forward price to earnings, I would say is roughly in line with the previous low back across the you know, 2011 to 2015 period. So I would say China's valuation are relatively cheap. So it really boils down to how fast they can really recover. But on a longer term approach, I think this could be definitely one of the places where you will not want to miss. But in terms of near-term trading, do expect some volatility. As I mentioned, near-term, you know, it still be somewhat jittery. We talk about, you know, a surge in cases. But longer-term wise, generally I am positive in terms of, you know, how in terms of the recovery, as long as they continue to move towards a full reopening into next year. Okay, Hang Seng Index, I think recently it has been a very key indices on what across many traders. We have seen this a very huge rebound, and recently it is back to retest. It's a 200-day moving average for the first time since, you know, last year July. So I think this is a very significant milestone. I mean, the 200-day moving average has been closely looked upon by many of the trend traders, or even many of the institutional funds, to dictate, you know, where the trend heading towards. So recently, it has hit the 200-day moving average. It is kind of being retested. So we will really have to see whether it can stay above it. I think near-term wise, things can still be jittery. I mean, we have looked at the negative performance in Wall Street to end this week. So that could cause some cautious environment in Asian indices on Monday. So we will really have to see how this 200-day moving average will play out. Because if we are able to see a break above it, you know, it could provide a greater conviction of a longer-term shift in trend to the upside. And last but not least, China A50, I think also promising, looking at these near-term higher high and higher lows formed recently. Generally, I'm looking for the 12,600 level as a form of a support. I think that provided, as you can, excuse me, as you can see from this chart here, it does provide somewhat of a Fibonacci confluence support zone. And in terms of resistance, I'm looking towards the 13,800 to 13,500 level. Likewise, that is also one of the sort of the previous peak whereby, you know, we see this sell-off coming on. So I think that could be one of the resistance on watch, whereas support will be at the 12,600 level. Okay, so with that, I've covered the three markets. I mean, Japan, Singapore, and also China, just to really share some of my views of where, you know, things could be headed. Hopefully, it will really be useful for you. You know, just to reinforce some of your views, or maybe to give you some room for thoughts. And hopefully, you'll find it useful. If you have any questions, you know, do feel free to put it on the Q&A tab, and then I'll see how, you know, I'll see which question I can answer.
Okay, thanks Jun Rong for the presentation. So if you have any questions right now, right, just feel free to type it into the question box and we can take about 5 minutes to answer. So I think the first one has already been covered. So we have a question on the Hang Seng Index recently increased more than 30%. Is it sustainable? So maybe just to reiterate from what was shared earlier, so Jun Rong is looking at the 200 day moving average. So I think that's one key level. So I think if it's trading above that, then we could see room for more upside. We have another question. Oh, okay, so this question is regards to the recording. So don't worry if you have missed the earlier part of today's session. We will be uploading it to both the YouTube channel and the IG Academy. So one thing I just wanted to highlight is that this particular summit is hosted by the IG Singapore office. So we can only post it in the IG Academy for the Singapore users or the YouTube channel for the Singapore office. So if you are receiving this invite, be it from our Australia regional office or the international office, or if you are a subscriber from Daily FX, just head over to YouTube and search for IG Singapore and subscribe to us. And once the video is uploaded there, right, you can have the notification firsthand to watch the earlier section. Okay. So just give me 1 second. Okay, so we have a question from Yeap. Is the worst over for China tech since government intervention? Do you have any views for like Baba or Alibaba and Tencent?
Okay, so I mean the best we can do is really to gauge the tone from the authorities to see whether we could be nearing the end. Of course, no one can pinpoint for sure. But for now, I think number one, with a greater focus on economic conditions, and number two, we are also getting somewhat of a quieter tone from the authorities as compared to a year ago. So that kind of remains supportive that the worst could be over for regulatory risk for China tech. But we know that the direction that the authorities are heading towards this common prosperity approach. So if you're talking about Baba and Tencent, generally they are the one that they are larger companies. They are put onto the front line in terms of the government crosshair. I would say that there's definitely room for recovery based on their valuation wise, but I will foresee a greater recovery towards a more smaller companies. So one of these, of course, on hindsight, right? One of these is Pinduoduo. I think that has really marked its 52 weeks high, just based on their resilience in earnings and also being less of being in the government's crosshair. Because I mean, common prosperity just means that everyone progress together. So if you are moving too far ahead, there could somewhat be a pulling back from the authorities in terms of more profits donation from you to really invest in other sectors itself. So I would say yes, room for recovery, but you may not expect much of a huge huge surge, but nevertheless I think it's a very attractive kind of a position to have over the longer term itself. Yeah.
Okay, so thanks Jun Rong. So I think we have one more question on the trade analytics. So before we end off, maybe just let me do a very quick screen sharing on the IG trading platform. Just give me 1 second. Okay, so previously back at the first speaker, right, we covered on this thing called trade analytics. So for those of you who join later, just take note that for all the live CFD trading accounts, if you click on this 3 button, there is this function of a trade analytics whereby you will be able to receive some insights of your winning rate, which market are you more successful at, what is the time frame that you're holding that is giving you more success and things like that. So this is only available for the CFD account. I don't think it is enabled for the shares dealing side. It's only for the leverage trading. So just to highlight that again. And on top of that, I just wanted to introduce a little bit on the products for IG. So be it if you are trading with the Singapore office, the Australian office, or our international office, here are some of the products that we have and providing you access to. So for the Singapore office, mainly we offer you access to global indices, domestic indices. So what a lot of our speakers have covered today were the US index, the Hang Seng, the STI, the Nikkei, and even VIX. So a lot of these you can trade them through this indices portion over here. FX wise is also something that we offer. So we have the dollar index, we have the majors, the minors, a lot of FX pairs for you to speculate into. And for the Singapore office, we also offer you access to commodities, so mainly the energy, which is the crude oil, natural gas, precious metals, your gold, silver, platinum, palladium, base metals, and the agricultural product, which is under soft commodities, and shares and crypto as well. So just to highlight a bit of the products that you're able to trade through us. Okay, if not, then just let me see if there are any last few questions that we can take. Okay, so maybe we can just take one final question before we end off today's session. So Jun Rong, we have one more that just came in on, your view when China eventually reopens, will the higher global inflation backdrop push up China's inflation?
Yeah. So to answer that, that's my own personal opinion, will be in second quarter. So second quarter next year. So generally my basis is that we have to get past that the Chinese festive season in January. So we may see a surge in cases. It will take a few weeks to really bring it down. So after that is over, I think it provides somewhat of a huge runway for China to really reopen more significantly. And will the higher global inflation backdrop push up China's inflation? Yes, I mean, if we are talking about a rebound, not just in terms of global inflation backdrop, but if we are talking about a rebound in a pent-up consumer spending, yes, that will push up China's inflation. But generally, number one, I think China's inflation is, for now, is still below the PBOC's target of 3%. And second, when we are talking about China's reopening, it could help to ease some of the supply chain intermittent disruption that we are talking about. So if they really fully reopen, I think the supply chain processes will be smoother. That could help to cushion some of these pricing pressure that we are seeing across the world. So it's sort of more of a push and pull effect for now. So we really have to see how things go. But with reopening, I think it does provide more of a positive backdrop, especially when we are seeing some of the headlines, inflation across the world are also coming down as well.
Okay.
Next question. Yeah, I saw the next question. I think it's on the outlook for the US dollar. So I think previously I've shown a chart. I think let me just move that.
Yeah, maybe I pass you the sharing access again. You can show that chart.
Oh, okay. Okay, just give me a moment. Yeah, I mean, of course, when we talk about the US dollar, for now, the terminal rate hike expectations from the markets have been very well anchored at around the 5% range. So now markets are really trying to figure out, whether we'll still need a more hawkish sort of a recalibration or whether that is enough already. So that will really determine some of the movement in the US dollar. But just looking at the chart itself, personally, just like I mentioned that I'm looking at the 105 level. I think that is the level where previously we have seen some deep buying. And looking at the near-term lower high and lower low, it does provide a near-term downward bias. And moving into next year, excuse me. And moving into next year, if you are talking about pricing for economic downturn, if you just look at past history, equities can fall alongside the US dollar as well. So when we are talking about a recession risk starting to become more amplified, I think equities could see downside, but US dollar could also see a downside as well. So I know for the whole of this year, the relationship has been US dollar up, equities down. Okay, US dollar down, equities is up. But that will be the turning point that I want to see next year in terms of the greater recession cause. Equities will be down and US dollar will be down as well. So I think moving forward, I'm still sort of I think the US dollar may have already seen a peak in my opinion.
Okay, thanks for the insights, Jun Rong. So I think we are about close to 10 minutes overrun. So once again, I want to thank everyone for attending the trading summit today. So we have come to the end of today's summit. I hope the session has been of value to you. And if you have missed certain parts of the session, once again, not to worry, we'll be uploading it on our YouTube channel and IG Academy as well. So with that, thanks everyone for joining, and we'll see you in our upcoming sessions. Okay, so cheers and have a great weekend.